All right, folks, welcome back. This is Volume 4 of a continuing series of 5 parts on the Inner Circle Trader Market Maker series. I'm going to be teaching time and price theory. All right, keeping in sync with our present market conditions and what has transpired this week in pound dollar. No better way to learn how to do something than to apply it to a chart that's actually trading and you watch unfold this week. We have the hourly chart here on British pound versus US dollar, and with all the things that were mentioned covered in the previous volumes of this series, if you haven't watched obviously part 1, 2, and 3 of this series, then you should not be watching this video yet because it's kind of requirement before you get to this. But the backdrop behind it is we've had S&P divergence down here. We've cleared out daily sell stops. So we've accumulated. We have a market maker buy model underway. And if that's what you're expecting and your analysis leads to a run above these relative equal highs and above the original consolidation here in the market maker buy model, let's incorporate the elements of time and price. So now I have the daily dividers on, and how I did this, in case you're wondering if you're new, all I did was create a vertical line and dropped it on the 0, 0 level on the time axis down here. That's going to be midnight New York time. If you have your time, it's important that you have your chart set to New York local time. That'll make understanding what I teach easy to follow along because your charts will look like mine, and also you'll be looking at it through the lens of the algorithm. So New York midnight time is delineated each day. So we're looking at obviously today's trading in Friday, Thursday's trading, Wednesday's trading, Tuesday, and then finally Monday's trading of this week. Now when you're looking at this, go back and look at your notes, and we've outlined how this week of trading, July 26, 2021 to July 30th, 2021, was bullish for pound dollar. I made the case for it, why it was bullish. I pointed to where it was going to go, how it was going to trade there, and we have it here now in hindsight. So if you look at each individual day as 1/5 of the weekly range, each of these days have specific characteristics that are repeating in nature. Now, they're not always exactly the same each week, but what I'm going to teach you here, I've covered in other lessons in this YouTube channel. But for continuity's sake, and kind of like bring everything that you should have collected along your journey through all my videos here, we're looking at the delivery of the weekly range. And if we're bullish, the expectation is that there's a 70% chance that the low of the week is going to form on Monday, Tuesday, or by Wednesday's New York session. Now, right away, you're probably thinking, oh, that's a pretty wide envelope of time. You got a lot of ways to get it wrong. Well, consider what we have here. We have Monday's trading. We're already in a consolidation, and we left the consolidation. So is it likely to come back down and go below this low here when it's already taken out a low there? Remember what I've taught you so far in this series. Before price movements that are directionally driven, typically opposing stop losses will be taken, and then price will be allowed to deliver in your expected direction. In layman's terms, if you're bullish, look for swing lows to get traded below, and then it starts to move higher. Short-term low, trades below it, and then it starts to trade higher. Okay. Each day of this week was predominantly bullish until we get to Friday. Obviously, that ends the week. So if we look at a open, high, low, close perspective of the week, we see the week opening here. Small little movement lower, creating the low of the week on Monday, a retracement and a buying opportunity on Tuesday, a retracement and buying opportunity on Wednesday, and then Thursday creating a short-term high of the week, and then Friday we went just above the Thursday high, but not by much. And then we traded off the high, and we're probably going to close anywhere between 139.20 and 139 big figure. Okay, so going back to what I mentioned here and what I've taught in other lessons on this YouTube channel is that we want to be buying on Monday, Tuesday, and at the best case scenario, if we missed buying opportunities on Monday and Tuesday, we want to try to buy on Wednesday in the New York session. Okay, but we'll talk more about other things that were factors this week as we go into the series in part 5. But for now, I want to bring in the opening price each day here at midnight. So we have this opening price here, extended out in time. How far is this going out? It's just showing till 10 a.m. You can take it out to 11 a.m., which basically is the heart of London close. So the idea is if you're bullish, you want to be buying at or below or very close to the opening price each day. We see it trade below the opening price and it rallies up. Day here, it opens and trades down all through London and then rallies higher on the day. Opening price here. We initially start to go higher, but then we trade down below it, and then we have another whipsaw below the low here on FOMC, and then trades higher. And then on Thursday, we're not incorporating the opening price on Thursday, and this is for your notes. Make sure you write this down. We're only looking for the influence of the opening price and buying below it or at it in a bullish expected week on Monday, Tuesday, and Wednesday. Thursday and Friday, they tend to create the opposite end of the weekly range. Okay, so try not to be looking to be a buyer on Thursday. Try not to be a buyer on Friday with the weekly range expectation. If you do that, you're going to miss trades, yes. But by far and large, you're going to protect yourself by avoiding being a buyer in a market move that's already been moving. Okay, obviously there's going to be days where it just continues on a Thursday and then Friday really explodes even higher. I've seen that happen in my own trading. I've missed pretty big moves on Friday, but I generally keep a small piece on, as I illustrated this week with trading the FOMC day. So I bought on this day, I bought on this day here, and I recorded and shared the FOMC trade and put it on my Telegram channel. You can see that, and left a small piece on, and it got me out at 139.50 on a limit. So you can design this any way you want. You can create a model where you get in on a Tuesday after you've seen Monday prove that it's wanting to go higher, and then it trades down below some short-term low, picks up the stops, and we have optimal trade entry here. And you can be a buyer there and basically allow Monday to trade without you. Or if you're hardcore and you're in consolidation like this and you think you are in a move where it's going to start to go higher rate from Monday's beginning of trading, then obviously you can put a small little position on there and then consider maybe taking a larger position once you have a better confirmation of the weekly range unfolding to the upside and a retracement down. As a new student or a new trader, when you see a day like this, and most of you probably have 1 and 5 minute charts up on your chart, you see this decline like that, it's heart-stopping, especially if you don't have any experience. You're thinking, man, there's no way I could be a buyer of that. Well, we have relative equal highs. The bottom line is it's going down to pick up the sell stops. Flood the market with sell stops, allowing smart money to buy those sell stops. And then it takes off and goes higher. Each day of this week between Monday and Wednesday is offered a buying opportunity to get us above our target that was established for the weekly range, was trading above here for the buy stops. So let's strip this down and go a little bit closer. So we're zoomed in on an hourly chart. You can see here's Monday's trading, Tuesday's trading, sweeping below that short-term low there, and rallying. And we drop down here on FOMC Wednesday. It starts to come down and give us a buying opportunity here, but then on FOMC 2 o'clock in the afternoon New York time, the market whips down, knocking out traders that would have already trailed their stop loss right below that low. It gets tagged, and then it runs aggressively higher above that original consolidation, which is that red line here. So above that red line is our buy stops that we were aiming for. that I started teaching you about in the earlier parts of the series, in the earlier portion of the week. Then ultimately we trade, creating a short-term high on Thursday, slightly higher on Friday, and then profit-taking model kicks in, and you can see it returning back to that original consolidation. Study the relationship of the opening price at midnight in New York time and how buying below that opening price is ideal. This is where smart money accumulates longs. This is where smart money accumulates longs. And this is where smart money accumulates longs. They distribute their longs on Thursday and Friday if it offers higher prices. And then you expect price to come off that and trade back down into the range, which is the highest high formed intra-week to the low. And we're seeing that here. Now, if you look at it on a 15-minute time frame, I'm going to incorporate day of week and time of day. Here's that opening price at midnight. The market trades down, creating the low in London, rallies, comes back down in for an optimal trade entry. If you don't know what an optimal trade entry is, there is lots of videos on this YouTube channel that you can study and find out what that is. It's a really simple pattern, repeats all the time. So it creates an optimal trade entry right there. You can be a buyer there, and then trades back down again. We have a short-term low here and a short-term low here. And this low is during New York Open. So short-term low here to high, down in, and taking out a short-term low. What's occurring? They're taking out short-term stops right below here and optimal trade entry. Rallies in New York and continues higher. The next day, the market trades back down into the range that was established on the previous day. This right here is the reason why most of the time I'm leaving Monday's trading to everyone else. Because if I establish a long here and it starts to rally up, I may make the mistake of trailing my stop loss up to here, and then they take it on Tuesday, and then I got to go back in and reposition myself. So I want to study on Monday what they do, and then on Tuesday, generally that's my action day. And you can see there's a lot more animation in price on Tuesday, but look what they do. They drop it down into London, creating the low of the day, taking out this short-term low again the previous day. And if you look at the low to high, you're getting optimal trade entry there. The key is OTE, or optimal trade entry, is associated with time of day, a kill zone. These little hyphenated segments of annotation on the charts, London is delineated by 2 a.m. to 5 a.m. New York time. So again, if you're setting your time on TradingView to local New York time, always set it to that. No matter what location you are around the world, always look at TradingView through the lens of New York, period. If you do that, everything I teach you will make perfect sense. You won't be confused. But London kill zone is 2 o'clock in the morning to 5 a.m. New York is 7 a.m. to 10 a.m. And if you want to use the New York session time, not the New York kill zone, the New York session time is 8:30 in the morning to 11 a.m. New York time. But each turning point that occurs at these kill zones sets up a really nice run in price. See that little short-term low right there? It trades down below it and then takes off. So we're seeing this element of time, which is also associated with the day of the week, because day of the week is still an element of time. It's a calendar reference point to time. It's a block of time that we call Monday, Tuesday, Wednesday, and so forth. So the element of time and price is important because you need to focus and expect your analysis to be rooted on the first element, which is time. The markets will not generally give you setups that pan out between these two windows. There'll be a quiet little period, even though we have a nice run in here. Sometimes that will occur. Most of the time, it won't be like that. It'll be consolidation. And then after London close, you get these consolidations like this. This is like dead time. Again, same here, dead time. Same here, dead time. So we're looking to engage, if we're bullish, like we were teaching in this series, pound dollars bullish, Monday creates the low of the week. Tuesday creates a buying opportunity. New York on Wednesday, nice buying opportunity, but you have to have a wide stop. And if you get stopped out here, you can use obviously other approaches to getting involved with the marketplace with FOMC. But I'm going to teach you and remind you that you should not be trying to trade FOMC if you're a developing student, because it's too much of a whipsaw and you're going to get caught up with the short-term volatility, and you're going to be more paralyzed by fear, even with a demo account, and left confused than that of if you just simply study it from the sidelines and don't engage it at all. Okay? But the element of time is the first crucial factor to reading price. Price, when it gets to these levels that we look for below the opening price, okay, what price is important below the opening price? What time of day during London Open? These are buying opportunities here. This low, trading below this low, is a reference in terms of price. By itself, doesn't mean anything. Sometimes you can see a short-term low like this. We have these lows here, all three of them. 1, 2, 3. Look at this. We went down below it. So that's one of those times where ICT talks about, oh, this is when we went below the lows and expect price to blast off. No, because we're inside of a time window that's not important. It's not salient to the underlying bias because it's dead. It's time when the algorithm is sitting still. It's going to just mark time is all it's doing, going sideways, just like it does here and like it does here. Okay, so the element of time is crucial because that's when the market will start to spool. That means the market will start unraveling in one direction or another, just start shooting off into a specific direction, aiming for a particular price. But when you're looking for price to behave a certain way, it needs to be inside of one of these kill zones for the highest probability. After London close each day, you should train yourself to anticipate consolidation, unless we get something like FOMC days, which is obviously, this is something that is not an every week instance. But you need to be looking at your economic calendar, because if you don't, you'll be caught off guard with these types of events, and you either want to be protecting yourself by not being in the marketplace or taking considerable amount of your position off ahead of it, so that way if it does reverse on you, you've paid yourself. But time is the first element. Keying up on Monday, Tuesday, or Wednesday for your trading. Now, if this was a bearish week, same thing, we'd be expecting a high to form on Monday, Tuesday, or Wednesday by New York session. But after Wednesday's New York session, probabilities start to fall off precipitously about catching shorts or trying to nail the high of the day when you're in bearish market environments. This week, we're going to stick with the narrative that we've outlined initially, is that this week was bullish. We've outlined why. I gave you examples on Telegram, and I showed you the fruits of it using this information. This little exclamation point is just highlighting the release of FOMC data. Okay, so this is 2 o'clock in the afternoon, New York time. Expect the volatility, and even though we had the run below these lows here and started to rally up, this is classic FOMC. This is exactly what non-farm payroll does generally too. So if this was 8:30 in the morning on a Friday on non-farm payroll, this is what you would expect to see on non-farm payroll. If you're in an underlyingly bullish market, same scenario. But I digress. So looking at this from the element of time and price, we know how to group an expectation and perception of analysis. When we look at time, we know there should be something occurring, but we have to anticipate that something, rooting it to the bias. What's the bias? Do we think the weekly range is going to be higher or lower? We don't care about that weekly closing price. I don't care where it's going to close. Where's the volatility going to send price? Mostly higher or mostly lower over the course of the days of this week? If I'm thinking bullish, I'm going to be focusing on Monday, Tuesday, and Wednesday, because I know the algorithm generally presents the really choice setups, if it's bullish, to be a buyer on Monday, Tuesday, and or Wednesday, but by Wednesday's New York session. Now, because Wednesday had a high volatility news driver with FOMC at 2 o'clock in the afternoon, that gives us a little bit more energy likely after 2 o'clock on FOMC's release. And we see that happen here. And it rolls over into Thursday's trading and so on. But knowing where you should be trying to buy, if you're bullish, you're trying to get below the opening price at midnight. That's a threshold that makes your trade higher in probability. It doesn't guarantee profitability. It just means it's higher probability that you're buying a really cheap market. And you're buying it when smart money buys it. You're looking at prices that trade either to an optimal trade entry, to an order block, or runs out stops. If we're bullish, when you're trading your plan, okay, you have to have a plan, right? The plan is every time you create a short-term low, notice to see if it does a run below that while you're bullish inside of one of these kill zones. Relative equal lows, you see that? We trade down below that in London and below the opening price by itself, that's a buy. Now, you probably won't trust that because you want to have indicators, you want to have moving averages, you want to have all these other things that you put your faith in. All that faith that you have established on retail logic and indicators and harmonic this and supply zone that, just reappropriate those faith tendencies on what I'm showing you here, because this is the truth. It's not about me, okay? It's not true because Michael says it. It's true because this is the truth. And I'm just the sounding board for it, okay? Once you understand this and you start studying it like this, you're going to see it's always been there. Always. But these 3 days and this element of time, that is crucial. And in what price? Where's the price factor in? Price is when you're taking out stops, returning to an order block or an optimal trade entry. That's it. There's 3 little things there. Okay, 3 little things that you need to worry about. And not all 3 form at the same time. So you need not worry about, well, how do I know if it's going to do this and how do I know if it's going to do that? Well, look at, you have a low here forming, and then it trades down below it again. That might be what you're waiting for your model. You may not want to trade order blocks. You may not want to trade optimal trade entries. You just want to see a low and then wait and see if it runs below that low during London at a time when we're bullish on a Tuesday or Wednesday. And you could be a buyer there, expect price to rally up to 10 o'clock to noon, which is London close. And that's usually when it meets the opposite end of the daily range. Don't take my word for it. Go through your charts and study it. That's what the algorithm will generally try to do on Mondays, Tuesdays, and Wednesdays when the market is predominantly bullish for the week. Now, obviously, if there's an objective that we're looking for on the week and it hits it on Tuesday, okay, so we were bullish on Monday and Tuesday it rallies up. Say it went above that red line, which is that buy stop liquidity pool that I've outlined earlier in this series. And say it ran through that 20, 30 pips. That would mean we have potential for the market to go into consolidation the rest of the week or have a deep retracement. Whereas we see on Tuesday, we didn't get to the high yet and sweep those stops yet. On Wednesday, we didn't get to it until here after FOMC. But did it do it convincingly above? No, it just went really lightly above, shallow run right there. And then later on in the day, when nobody's really paying attention, it starts to rally straight on up. So you got to factor the element of price for where you think price is going to reach for. So time and price theory. You're blending these things together to come up with a narrative that you want to follow. And you want to see if price is sticking to that narrative that you've outlined, or scenario, I guess it would be a better analogy. You're creating a scenario where you think, based on these times of the day and these days of the week, and the logic that this market's likely to go higher, to where that weekly buy stop liquidity pool I've outlined in this series that we've been harping on every time we've had a video. We're watching how all these things come together to give us a narrative that is delivering in price. And nothing here is random. It's exactly how it should be. If it's bullish, when should it create a low to go higher? In one of these, if not all of them, London and New York kill zones. Just look at the chart right here. These windows of time, I taught this over 10 years ago. For free, right on Baby Pips, taught it. And they still work today. They were working before I taught it. They're going to keep working, okay? The reason why is because the flows that come in at that time of the day creates the opportunity for the algorithm to move around. The flows or buying volume and selling volume is not moving price. The algorithm is operating on the time window. It knows the trading volume increases then. It's not a derivative of, okay, lots of buyers are coming in, so I'm going to start seeing price go higher because of that. No, that's not what it is. And I don't care who told you otherwise. It's not what's going on. These markets are absolutely manipulated, controlled, period. The state of a country's economy and the solvency of a central bank is not going to be put in the hands, okay, of Reddit. I mean, if everybody around the world said, hey, look, here's what we're going to do. We're all going to buy the British pound. And we're going to keep buying it no matter what. You really think that's going to be the catalyst for the British pound to go up and keep on going up no matter what? No way. But if you read social media today, that's what they want you to believe. That stocks are going to go to the moon because a handful of people on Reddit are buying it. That's not what these markets are doing, okay? These are the commodity. These are the products of a central bank. Their business is to control everything. Everything. And we as traders will never, absolutely never, ever, ever push price higher or lower because of buying and selling pressure. It's not going to happen. If they don't want it to go higher, it doesn't matter how many people buy it. It isn't going higher. That's it. So on the latter part of the week, you can see here on Wednesday's FOMC, we rolled into Thursday's trading. Nice little optimal trade entry here on London, sticking to the theme, and we ran up 80 pips above the 139 big figure. The 139.10 level is where that buy-side liquidity pool was basically linked to on the weekly chart. So we went 70 pips above that. That's a pretty good run. And here it is. We're on Thursday in the New York session, and then finally London close. Creates the high of the day, starts to drift lower, and then finally one more pump up in on London on Friday, running just a little bit above Thursday's high, and then we have a breakdown, and we'll look at that on a 5-minute chart. But we'll look at that when we get into the last part of the series. But each day has signatures that it follows, responds to in terms of time and price. It's not something that is random. It's fitting specific logic that has been taught in this YouTube channel. I can't take over 100 some different videos and compress it into one video and say, this is all the moving parts all at one time, but everything I'm showing you here has been amplified in other teachings, introduced obviously in teachings, and also shown by example. And now here it is again being shown to you where it's still working. We're going to take a closer look into lower time frames in the final volume on this series. Until then, be safe.